Watch out for gaps rule. This is an incredibly important rule, but it depends on the type of market that you are trading. Myself personally, I'm trading the full future DAX, the German indices, the overnight one as well, so that I don't trade at night, but if I wanted to, I do see the movement that happens at night. So let's say when the Asian market opens and when the Asian companies trade, something still happens at night. And this is where the gaps come from if you do not have the overnight market. Now let's see the example here. We can see that the market closes at 17:30 and then opens again at 9 o'clock. So it opens at the same time as I was explaining in the previous lesson, but you do not have the overnight view, so the market closes earlier. And that really depends on the market that you're trading. But I do prefer to see the night, but some people don't like to see the night. They just like to have their work day, 8 hours or 9 hours or whatnot, and then the market closes and they are done with trading for the day. So in case if you're trading one of those markets where you have gaps, so when you don't see the night, then you must watch out for those gaps. Let's say, for example, here, the gap is quite small, but it still is relevant. And this place here, as we can see, this happened today. So the market yesterday closed around 13,180, and it opened today at 13,261. So pretty much 80 points higher. Now, how is this relevant to our expectations, and why do we need to keep track of this? Now, the gaps themselves in general, they are very, very systematic in terms of closing this gap. So the market really likes to close the gap. Not always, sometimes we can open a lot higher and keep climbing. Yes, this does happen, but more often than not, the gap will be closed. The market will try to close the gap at least partially. And that we need to keep in mind. It's not going to help us trade very much, but this kind of a mathematical expectation and in terms of the statistics and the probability of the market action, we need to keep this in mind. Now, how is this relevant to the ATR? So the question is, as you can remember, there is this market opening price. This is the level from which we calculate the ATR. So as you can remember, that the market opening is the zero ATR, and then in the few hours, wherever it moves, we calculate how many % did the market move from its ATR, average true range. Now, in the case with gaps, as you could imagine that, I would say that the zero ATR would be here, and we would start calculating the ATR from here. But that's not the case. With the gaps, the ATR is actually the gap is being calculated into the ATR. So that means that the ATR is going to be calculated from the closing price of the previous day. So if we have a gap of 80 points up, and as we counted before, that the ATR of the DAX at this point is around 117 points, that means that we are around 70-something% of the ATR already. So if we were to see a climbing signal anywhere around here, we would do what? Exactly, we would do nothing. We would not take it, simply because we wouldn't want to go against the statistics and the probability of the success of a signal. And we would actually entertain a signal into falling, which we probably would not be able to find in this straight line down, since there is no structure. But around this place right here with the indicators, we might actually find something. So this kind of a signal from around here, this area, would work very nicely, and the ATR concept would support our decision to do so. Now, so once again, the ATR is in case with the gap, the ATR will be calculated from the previous closing of the day. So this gap would be calculated right into the ATR. So we open 80 points higher. That means that right from the start, our ATR is already not a zero, but in this case, more than 70%. Here, let's take a look at another example, which is this day right here. So we would not mark our ATR, zero ATR from here, which is the theoretical and the exact market opening price, but we would actually mark the zero ATR from the closing of the market from the previous day, which would be here. And as we can see that the market opened roughly 30 points lower than the previous closing price. So 30 points lower, and that means that around 20-25% roughly, I'm just calculating it in my head, 20 to 25% of the ATR has already been eaten up. So we would still be able to go into falling prices. The ATR would allow us. Remember that around 50% of ATR, anything above 50%, we should never think about going into trend, only against the trend. And if the market moved more than one ATR, or sometimes it moves two ATR, and anything above one ATR, the probability of the turnaround is 80%, and the probability of continuation of the trend is 20%. So 80 to 20, I'd rather use the possibility which has a probability of 80%, not the 20%. Just a small reminder of what the ATR is. We'll talk about it many more times later on. So if so far you're a little bit iffy on the ATR, don't worry, we'll cover it many more times, and there will be more homeworks on the ATR, and I will make sure that you understand this concept completely. All right, this lesson is coming to an end, and these lessons have been quite short. I tried to really compress them to the best of my ability. There is still so much of stuff to cover, and the long lessons with a bunch of talking would make no sense. So I'm trying to keep them as short as possible, and I hope you're enjoying the short lessons, because soon enough there will be many long and difficult lessons. So brace yourselves and enjoy the test, and good luck with your homework, and I'll see you in the next lesson.